We live in a world with a lot of information, and it moves fast. With smartphones, we're now walking around with all the information we want to access in the palm of our hands. And the investing landscape is no different. Information about economies, companies, and industries flows through at breakneck speed, and the last quarter was a great illustration of that. It showed how quickly expectations change and how that impacts prices just as fast. The end of 2023 saw expectations shift from an economic backdrop of continued inflation to one where inflation is moderating and the hopes of a soft economic landing without a recession increased. This was driven largely by comments and data points from the US Federal Reserve. In response to these changes, market prices across the board moved markedly. Government bond yields globally moved dramatically, particularly in the US, where the 10-year bond yield fell over 1%, a large move considering the starting point. Equity markets rose strongly in response to these changes, with assets sensitive to the economic cycle. High growth sectors like information technology and those with leveraged business models were buoyant. Property trusts, which are both economically sensitive and highly indebted, were a standout over the final quarter in 2023. Trying to invest for changing economic conditions in the short term is notoriously difficult. However, it doesn't mean you can't use the noise as expectations change to your advantage when setting portfolios up for the long term. With a focus on a valuation-first mindset, you can build a portfolio with good return prospects, affordable diversification, and multiple return drivers, designed to deliver in multiple scenarios. By understanding how changing expectations can impact particular assets, this can guide you where to look rather than trying to predict where they go. Given the increased prices, valuations across the board are more elevated, but select opportunities are still out there. Emerging market equities are attractive, including China, with the latter suffering from extremely poor sentiment. Bonds, despite the fall in yields, are still a viable asset from a diversification perspective, which has not been the case for a large part of the last decade at now long forgotten lower yields. The portfolios are suitably calibrated heading through 2024 and importantly beyond. This is when we see fundamentals of assets come through and patience, an often forgotten skill in a fast and furious world, is rewarded.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.